Hey guys, this is Dawson Discussions, and my name is Nathan L. Dawson Jr. Today's date is June 11th, 2022. In today's video, I'll be talking about investment funds and how I think it actually can help build wealth. So stay tuned. So essentially, an investment fund is a way of investing money alongside other investors to benefit from the inherent advantages of working as part of a group, such as reducing risk of the investment by a significant percentage. Essentially, they pool their money of many investors and invest according to a specific strategy. An investment fund is a supply of capital belonging to numerous investors used to collectively purchase securities or those tradable liquid assets, while each investor retains ownership and control of their respective shares. An investment fund provides a broader selection of investment opportunities, greater management expertise, and lower investment fees than investors might be able to obtain on their own. With investment funds, individual investors do not make decisions about how a fund's assets should be invested. They simply choose a fund based on its goals, risk, fees, and all other factors. Investment funds are usually the starting point of many individual retail investors because they offer a balanced portfolio in a single investment. So essentially, the price of the investment fund, also known as the net asset value or NAV, is determined by the total value of securities in that portfolio divided by the number of funds outstanding shares. This price fluctuates based on the value of the securities held by the portfolio at the end of each business day. Note that investment fund investors do not actually own the securities in which the fund invests. They only own the shares of the fund itself. For the average small investor, mutual funds can be a smart and cost-effective way to invest in the stock and bond markets. While individual purchases may vary by fund, it can be as low as $100. Most funds will let you buy shares with as little as $3,000. In addition, minimums are often waived or reduced if investors buy a fund within a retirement account or use certain brokerage features like automatic investments to regularly invest over a set time period. Buying shares in a mutual fund is also the easiest way to help diversify your investments. So, for instance, most mutual funds hold well over 100 securities. For someone with a small sum to invest, building and managing a portfolio containing that many securities could potentially be highly impractical, if not impossible. So, what are the benefits of investing in a individual fund or a investment fund in general? So for one, you have the professional management. As a mutual fund investor, you get the benefit of having a professional manager reviewing the portfolio on an ongoing basis. Professional portfolio managers and analysts have the expertise and technology resources needed to research companies and analyze market information before making investment decisions. Fund managers identify what securities to buy and sell through individual security evaluation, sector allocation, and analysis of technical factors. For those who have neither the time nor the expertise to oversee their investments, this can potentially be invaluable. Liquidity and convenience. All mutual funds allow you to buy or sell your fund shares once a day at the close of the market at the fund's NAV. You can also automatically reinvest income from dividends and capital gain distributions or make additional investments at any time. For most stock funds, they require minimum initial investment may substantially be less than what you would have to invest to build a diversified portfolio of individual stocks. The tax considerations. Well, the securities held within a portfolio often pay dividends or interest. So the securities can be sold by the fund manager after rising in value. These types of events can help generate income for the fund, which by law must be paid out to the investors in the form of periodic distributions. For the most part, the investors who own shares in the mutual fund at the time these distributions are made are responsible for the taxes on that money. However, the income from funds that invest in municipal bonds may be exempt from federal, in some cases, state taxes. Investors who own mutual funds that are not held within an IRA or a tax advantage account may be subject to different types of taxes. One, dividend income, which is generally taxed at your ordinary income tax rate. Two, capital gains for the sale of securities, which can be taxed at your ordinary income rate or the more favorable long-term capital gains rate, depending on how long the securities were held by the fund. Short-term capital gains would be less than 1 year, and long-term capital gains tax would be at least a year and 1 day. And capital gains when you sell or exchange shares of the fund at a profit. Those capital gains could also be taxed at your ordinary income tax rate or the more favorable long-term capital gains rate, depending on how long you held those shares. And also fees. With any business, running a mutual fund involves costs. Funds pass along these costs to investors by charging fees and expenses. Fees and expenses vary from fund to fund. A fund with high costs must perform better than a low-cost fund to generate the same returns for you. Even small differences in fees can mean large differences in returns over time. For example, if you were to invest $10,000 in a fund with a 10% annual return and annual operating expenses of 1.5%, after 20 years, you will probably have roughly 49,725. If you invested in a fund with the same performance and expenses of 0.5%, after 20 years, you would end up with $60,858. Essentially, that is an $11,133 difference. There are a variety of fees that may be associated with mutual funds. Some funds come with a transaction charge for buys and sells or commission known as loads. And there are funds that charge a redemption fee if you sell shares you only own for a short time. Investors also pay ongoing expenses to cover the cost of operating the fund. This includes investment advisory fees, paying the fund manager and the research staff, as well as transaction costs associated with buying and selling those securities within that fund. When evaluating a fund, remember that fees play a factor and may potentially detract from the fund's performance over time. A fund's past performance is not as important as you might think because past performance does not predict future returns. But past performance can tell you how volatile or stable a fund has been over a period of time. The more volatile the fund, the higher the investment risk. So what are the types of mutual funds are out there? Most mutual funds fall into one of the four main categories: money market funds, bond funds, stock funds, and target date funds. Each fund has its different features, risks, and rewards. So the money market. Money market funds have relatively low risk. The money market is a component of the economy which provides short-term funds. The money market deals in short-term loans, generally for a period of a year or less. By law, they can invest in only high-quality short-term investments issued by U.S. corporations, federal governments, state governments, and local governments. Unlike most mutual funds that are invested in stocks, money market mutual funds usually try to keep the NAV of each share at $1. They are allowed to do so because they are invested in safe short-term debt. This keeps their investors from changing the value on the books every day. They pay dividends instead. The value of the money market mutual fund is dependent on the yield or interest rate, which does vary. It is very rare for the NAV to fall below $1. Money market mutual funds invest in these types of low-risk securities. So one, you have your treasury bills. These are backed by the federal government. Two, you have certificate deposits. These are loans made to a bank for a short period. They are very safe and they return a fixed interest rate for the life of the loan. And also, three, commercial paper. Commercial paper are debt issued by very reliable companies. This is a short-term debt that large companies can use instead of going to a bank for a loan. Only well-regarded companies can do that because the debt is nothing more than a promise from the company that it will be repaid. There are no assets that are backing the loan. Usually the company has enough outstanding invoices known as those receivables to support the loan. It just needs the money now to pay for day-to-day operations or to future payments for orders come in. It's like a payday loan for a business, but you're the owner. The company promises it will repay the debt within a year, if not sooner. One of the worst disadvantages is that money market mutual funds are not insured by the Federal Deposit Insurance Corporation, or FDIC. And also, whenever interest rates are low, these funds may pay less than the rate of inflation. When that happens, fund investors are actually losing their buying power. They're still a good investment for those who cannot afford to take the risk required to stay ahead of inflation. That includes investments such as stocks, corporate bonds, or those higher yield mutual bond funds, also known as junk bonds, because they're low quality, but they pay a very high dividend. Not dividend, a high coupon payment, because the credit score of that business is low, so they have to compensate the risk by actually paying you more money if you're a junk bond / high yield bond investor. Also, speaking of bonds, Bond funds have higher risk than money market mutual funds because they typically aim to produce higher returns. Because there are many types of bonds, the risk and rewards of bond funds can vary dramatically. A bond is actually an instrument of indebtedness under which the issuer debtor owes the holder creditor a debt and is obliged, depending on the terms, to pay them interest, which is the coupon, as well as to repay the principal at maturity. Stock funds invest in corporate stocks. Not all stock funds are the same. Some examples are growth funds, income funds, and index funds. And you also have your sector-specific funds. And lastly, you have your target date funds, which actually hold a combination of stocks, bonds, and all other securities. Over time, the mix gradually shifts according to the fund strategy. Target date funds, sometimes known as life cycle funds, are designed for individuals with particular retirement dates in mind. Okay, actively managed mutual funds. In an actively managed portfolio of investments, the investor selects the investments that make up the portfolio. Ideally, the active manager exploits market inefficiencies by purchasing stocks that are undervalued or by selling securities that are overvalued. Either of these methods may be used alone or in combination. Depending on the goals of the specific investment portfolio, hedge fund, or mutual fund, actively managed securities may also serve to create less volatility or risk than a benchmark index. The reduction of risk may be instead of or in addition to the goal of creating an investment return greater than that benchmark. So what are the advantages? Well, an investor may believe that actively managed funds do better in general than those passively managed funds. Investors also believe that they have some skill for picking which active managers would do after they have invested. They may believe that some market segments are less efficient in creating profits than others. They may want to manage volatility by investing in less risky yet high quality companies rather than in the market as a whole, even at the cost of slightly lower returns. Conversely, some investors may want to take on additional risk in exchange for the opportunity of obtaining higher than market returns. Investments that are not highly correlated to the market are useful as a portfolio diversifier and may reduce overall portfolio volatility. And lastly, some investors may wish to follow a strategy that avoids or underweights certain industries compared to the market as a whole, and may find an actively managed fund more in line with their particular investment goals. For example, an employee of a high technology growth company who receives company stock or stock options as a benefit might prefer not to have additional funds invested in the same industry. So what are the disadvantages? Well, the most obvious disadvantage of active management is that the fund manager may make bad investment choices or follow an unsound theory in managing the portfolio. Data from recent decades demonstrate that the majority of actively managed large and mid-cap stock funds in the United States fail to outperform their passive stock index counterparts. The fees associated with the active management are generally also higher than those associated with passive management, even if frequent trading is not present, reflecting in part the additional research costs associated with active investing. Those who are considering investing in an actively managed mutual fund should evaluate the fund's prospectus very carefully. Active management strategies that involve frequent trading generate higher transaction costs, which diminish the fund's return. In addition, the short-term capital gains resulting from frequent trades often have an unfavorable income tax impact when such funds are held in a taxable account. When the asset base of an actively managed fund becomes too large, it begins to take on index-like characteristics because it must invest in an increasingly diverse set of investments instead of those limited to the fund's manager's best ideas. Many mutual fund companies close their funds before they reach this point, but there is a potential for a conflict of interest between mutual fund management and their shareholders because closing the fund will result in a loss of income as a management fees for the mutual fund company. Famous active managers I know of are Peter Lynch, William H. Miller III, and John W. Rogers Jr. Peter Lynch was the mutual fund manager who managed Fidelity's Investments Incorporated Magellan Fund. Between 1977 and 1990, Peter Lynch averaged a 29.2% annual return, consistently more than double the S&P 500 index and making it the best performing mutual fund in the world at its time. During his 13-year tenure, assets under management has increased from $18 million to $14 billion. He focused on individual companies rather than any overarching strategy, starting with large U.S. companies and then gradually shifting his emphasis to smaller and international stocks in the process. Lynch found success in a broad range of stocks from different industries. According to Being the Street, his book that he authored, his most profitable picks were the Federal National Mortgage Association. You might also hear it as Fannie Mae. Ford, Philip Morris International Incorporated, a tobacco company. One of the brands you might be familiar with is Marlboro. Microwave Communications Incorporated, or MCI, which was a telecommunications company that was headquartered in Washington, D.C., that was at one point the second largest long-distance provider in the United States. MCI was instrumental in legal and regulatory changes that led to the breakup of the monopoly of AT&T Corporation, and then it was later acquired by Verizon. He also invested in Volvo, General Electric Company, or the GE Company, General Public Utilities, and now it's called First Energy Corporation, which is an electric utility company which is headquartered in Akron, Ohio. Student Loan Marketing, also known as Sallie Mae. Kemper, which is an American insurance provider, and Lowe's, which is a home improvement store. His most famous investment principle is invest in what you know, which is popularized the economic concept of local knowledge. Since most people tend to become more experts in certain fields, applying the basic invest in what you know principle helps the individual investors find good undervalued stocks. Lynch uses this principle as a starting point for investors. He also often said that the individual investor is potentially more than capable of making money from stocks than a fund manager, because the individual investor is able to spot good investments in their day-to-day lives before Wall Street picks up on it. Throughout his two classic investment primers, he has outlined many of the investments he found when he was not in his office. For example, in a book, One Up on Wall Street, that he authored, Peter Lynch explained how he invested in Dunkin' Donuts. Not after reading about the company on the Wall Street Journal, but actually after being impressed by the coffee as a customer. Assuming others would be similarly impressed as he was, and noted that the Boston locations were always busy, he then studied the company's financial status and decided to invest in Dunkin' Donuts, which proved to be one of his best performing stocks that he ever bought. Lynch believes that the individual investor is also able to make similar smart investment choices, noting particular opportunities like Dunkin' Donuts, or paying attention to business trends in their careers and hobbies. Using examples from the Magellan Fund, his book outlined how a novice should read and interpret company paperwork for information on stock valuation, earnings, cash flow, and other data. Also, Peter Lynch popularized the investing strategy growth at a reasonable price, or GARP, or you just pronounce it as GARP, which is actually a hybrid stock purchasing approach that balances growth investing potential for share price increases with the discipline of value investing to avoid buying overpriced stocks. While the style may not have rigid boundaries for including or excluding stocks, a fundamental metric that serves as a solid benchmark is the price to earnings growth, or the PEG ratio, or the PEG ratio. This ratio says that if it's at 1 or less than 1, then it shows that the company is undervalued and it might be a potential buy. But if it's over 1, then the company is probably a potential sell, or it's overvalued. William H. or Bill Miller III. William H. or Bill Miller III is an American investor, fund manager, and philanthropist. He served as the chairman and the chief investment officer of the Legg Mason Capital Management, as well as the principal portfolio manager of the Legg Mason Capital and Management Value Trust. Miller is considered to be a value investor who believes that any stock can be a value stock if it trades at a discount to its intrinsic value. Miller has reiterated his investment philosophy multiple times in letters to shareholders, writing this in his 2006 letter. Value investing really asking what are the best values, and not assuming that because something looks expensive that it is, or assuming that because a stock is down in price and trades at low multiples that it is a bargain. Sometimes growth is cheap and value is expensive. The question is not growth or value, but where the best value. We construct portfolios by using factor diversification. We own a mix of companies whose fundamental valuations factor differs. We have high PE and low PE, high price to book and low price to book. Most investors tend to be relatively undiversified with respect to these valuation factors, with traditional value investors clustered in low valuations and growth investors in high valuations. It was in the mid-1900s or the mid-1990s that we began to create portfolios that had greater factor diversification. which became our strength. We own low PE and we own high PE, but we own them for the same reason. We think they are mispriced. We differ from many value investors in being willing to analyze stocks that look expensive to see if they really are. Most, in fact, are not, but some are not. To the extent we get to the extent we get that right, we will benefit shareholders and clients. The Legg Mason Capital Management Value Trust after fee return beat the S&P 500 index for 15 consecutive years from 1991 to 2005. Consistently producing market-beating returns is considered to be very unlikely according to the efficient market hypothesis. Miller once said, as for the so-called streak, that is an accident of the calendar. If the year ended on different months, it wouldn't be there, and at some point the mathematics will hit us. We've been lucky. Well, maybe not 100% luck, maybe 95% luck. Michael Mouse-Boson, former chief investment strategist at Legg Mason Capital Management, looked at the historical data on the percent of equity mutual funds that beat the market during the Value Trust 15-year streak. Because the number of equity mutual funds beating the market fell as low as 8% in one year and 13% in another. He estimated that the probability of beating the market in 15 years ending 2005 was 1 in 2.3 million. John Washington Rogers Jr. is an American investor and founder of Ariel Capital Management, or now known as Ariel Investments LLC, founded in 1983. He is the chairman and CEO of the company, which is the United States' largest black-owned mutual fund firm. And you also have Catherine Duddy, or Cathy Wood. She's an American investor and founder, CEO, and CIO, Chief Investment Officer of ARK Invest, an investment management firm. In 2001, she joined AllianceBernstein as Chief Investment Officer of Global Thematic Strategies, where she worked for 12 years managing $5 billion. She was criticized for performing worse than the overall market during the financial crisis of 2007 to 2008. In 2014, her idea of actively managed traded funds based on disruption and innovation was deemed too risky by AllianceBernstein. Wood had then left the company, and then she went on to found ARK Invest. The company is named after the Ark of the Covenant. Wood was reading the one-year Bible at the time. ARK first 4 ETFs were seeded with capital from Bill Hoang of Archegos Capital. ARK Invest focuses on investing in disruptive technology. These technologies include artificial intelligence, DNA sequencing, gene editing, robotics, electric vehicles, energy storage, fintech, 3D printing, and blockchain technology. It has also invested in cryptocurrencies. The company invests in stocks its projects to double in value over a 5-year period. From 2014 to 2021, the ARK Innovation ETF averaged an annual 39% return on investment, over 3 times the return of the S&P during the same time period. Other famous actively managed mutual funds that I know of is the T. Rowe Price New Horizons Fund, launched in the 1960s. In order to capitalize on the growth potential of so-called emerging growth companies, or those small, rapidly growing companies in the early stage of corporate development. New Horizons focused on technology firms like Texas Instruments, Hertz, Haloid, Xerox, which is the precursor of Xerox Corp, and Boeing. Also, the T. Rowe Price New Era Fund, the fund's portfolio investments advise natural resource companies, gold, silver, uranium, copper, and forest products, while mixing in some technology and a measure of more traditional growth stocks. Okay, an index fund. An index fund is a type of mutual fund designed to follow certain preset rules so that the fund can track a specific basket of underlying investments. The most commonly known index fund in the United States is the S&P 500 Index Fund, which is based on the rules established by S&P Dow Jones Indices for the S&P 500 Index. Equity index funds would include groups of stocks with similar characteristics such as size, value, profitability, and geographic location of those companies. So a group of stocks may include companies from the United States, non-U.S. developed, which is a country that is more developed in terms of the economy and capital markets. The company must be high income, but that also includes openness to foreign ownership, ease of capital movement, and efficiency of market institutions. Also, emerging markets, which is a market that has some characteristics of a developed market, but doesn't really fully meet its standards. And you have your frontier market countries, used for developing countries with smaller, riskier, or more illiquid capital markets than emerging. John Clifton, or Jack Bogle, is my personal, which is personally my most favorite stock market investor, and he was the founder and chief executive of the Vanguard Group, and is credited to creating the world's first index fund. An avid investor and money manager himself, he preached investment over speculation, long-term patience over short-term action, and reduced the broker fees as much as possible. The ideal investment for Bogle was a low-cost index fund held over a period of a lifetime with dividends reinvested and purchased with dollar-cost averaging. In 1976, influenced by the works of Paul Samuelson, Bogle went out to create the first index investment trust, a precursor to the Vanguard 500 index fund, ticker symbol VFIAX, as the world's first index mutual fund available to the general public. It was not immediately well received by individuals or the investment industry, but is now lauded by investment legend Warren Buffett and among others. Bogle argued for an approach to investing defined by simplicity and common sense. His 8 rules for investors are: select your low-cost funds. 2. Consider carefully the added cost of advice. 3. Do not overrate past fund performance. 4. Use past performance to determine consistency and risk. 5. Be aware of stars, as in star mutual fund managers. 6. Be aware of asset size. 7. Don't own too many funds. And 8. Buy your fund portfolio and hold it. So what are the advantages of a index fund? Well, for one, low cost, because of the composition of a target index is a known quantity relative to active managed funds. It costs less to run an index fund. Typically, expense ratios of an index fund can actually range from 0.10 or 0.10% for U.S. large company indices to 0.70% for those emerging market indices. The expense ratio of the average large cap actively managed mutual fund as of 2021 is 1%. So if a mutual fund produces 10% return before expenses, taking account of the expense ratio difference, would expect in an after expense return of 9% for the large actively managed mutual fund, but it's going to be a whole lot less for the index fund, because the index fund you'll be able to keep more of your money since you're not really paying a whole lot in fees. So if that actively managed mutual fund is 10% and there's a 1% ratio, then it will be 9% return. But if it's like an index fund, which is 0.10, then of course your return is going to be a whole lot higher than the actively managed mutual fund. Also, it's very simple. The investment objectives of index funds are easy to understand. Once an investor knows the target index of an index fund, what securities the index fund will hold can be determined directly. Managing one's index fund holdings may be as easy as rebalancing every 6 months or every quarter. Also, there's very low turnover, which is the volume of selling and buying securities by the fund manager. Because index funds are passive investments, the turnovers are lower than the actively managed funds. There's also no style drift. Style drift occurs when an actively managed mutual fund goes outside the described style, mega cap value, large cap income, to increase returns. Such drifts can actually hurt portfolios that were built with diversification as a high priority. Drifting into other styles could reduce the overall portfolio's diversity and subsequent increased risk. With the index fund, the drift is not possible, and accurate diversification of a portfolio is increased. So what are the disadvantages of an index fund? You have your tracking error. An index fund may not perfectly track its index. 2, there's not really a whole lot of flexibility. Index fund managers must follow policies and strategies that require them to attempt to perform in lockstep with an index. They enjoy less flexibility than managed funds. Investment decisions on index funds must be made within the constraints of matching index returns. For instance, if the returns of the index are declining strongly, index fund managers have a few options and attempt to limit those losses. In contrast, managers of an actively managed mutual fund have more flexibility to act to find a better performing option in good times and or in bad times. There's not really a whole lot of big gains with an index fund. I mean, an index fund does not carry the potential to outpace the market in any way because it mirrors it. This means that if you invest in an index fund, you're surrendering the possibility of a massive gain. The top performing non-index funds in a given year perform better than the top performing index funds, and the very best non-index funds can perform far better than the index fund. Also in a year. However, the top performing non-index funds may vary from year to year, so that underperforming years can actually cancel out the overperforming ones, while the index funds remain steadier. So the most popular index mutual funds are Vanguard Total Stock Market Index Fund, ticker symbol VTSAX, the Vanguard 500 Index Fund, VFIAX, and the Schwab 1000 Index, SNXFX. The Exchange Traded Fund. Exchange Traded Fund is a type of investment fund and an exchange traded product, as they are traded on a stock exchange. It's very similar to many ways to a mutual fund, except that ETFs are bought and sold from the owners throughout the day on a stock exchange, while mutual funds are only bought and sold from the issuer based on their price at day's end. An ETF holds assets such as stocks, bonds, currencies, future contracts, commodities, and all other securities, and generally operates with an arbitrage mechanism designed to keep it trading close to its net asset value. Other deviations can occasionally occur. Most ETFs are index funds. That is, they hold the same securities in same proportions as a certain stock market index or bond market index. In the U.S., the largest ETF issuers are the BlackRock iShares series with a 35% market share, followed by the Vanguard Group with a 28%, followed by State Street Global Advisors with 14%, and Invesco with a 5% market share. Charles Schwab with 4%. I think the remaining 14% will be companies like WisdomTree and others. So you have your commodity ETFs, investment precious metals, agricultural products, hydrocarbons. You have your currency ETFs, inverse ETFs, which constructed by using various derivatives for the purpose of profiting from a decline in the value of an underlying market or index, kind of like shorting, like short selling. It is a similar type of investment to hold several short positions or using a combination of advanced investing strategies to profit from those falling prices. Many inverse ETFs use daily futures as their underlying benchmark. And you also have thematic ETFs, which focus on long-term societal trends, such as disruptive technologies, just like ARK investor Kathy Wood. Some might focus on climate change or shifting consumer behaviors. Some of these popular things are cloud computing, robotics, electric vehicles, even the gig economy, e-commerce, and clean energy. So popular ETFs out there: VTI, Vanguard Total Stock Market ETF, VOO, Vanguard S&P 500 ETF, SPY, SPDR, the Standards & Poor's Depository Receipts S&P 500 ETF Trust, ARK Innovation ETF, VNQ, Vanguard Real Estate ETF, VIG, Vanguard Dividend Appreciation ETF, VYM, Vanguard High Dividend Yield ETF, SCHD, Schwab US Dividend Equity ETF, QQQ, the Investigo QQQ Trust Series, adjusted to track the National Association of Securities Dealers Automated Quotations Top 100 stocks. That index is more heavily tilted towards the information technology. You also have IVV, the iShares S&P 500, GOD, Spider Gold Shares, SLV, iShares Silver Trust. Active or passive? Okay, so David Lawrence, or Dave Ramsey III, is an American personal finance personality, radio show host, author, businessman, and investor. He is a evangelical Christian and hosts the nationally syndicated radio program known as The Ramsey Show. Ramsey has written several books, including the New York Times bestseller, The Total Market Makeover, A Proven Plan for Financial Fitness, and more recently, Baby Step Millionaires. And he hosted a television show on Fox Business from 2007 to 2010. So Ramsey investment advice has also drawn criticism for a few reasons, because Dave actually suggests that investing money in 4 categories of actively managed mutual funds with loaded fees, and to spread them out equally, 25, 25, 25, 25. So, according to his website, Growth and Income, he says that these funds create a stable foundation of your portfolio. These can be described as large, well-known, big and boring American companies that have been around for a long time and offer goods and services people use regardless of the economy. Growth. This category features medium or large U.S. corporations that are experiencing growth. Unlike growth and income funds, these are more likely to ebb and flow with the economy. For instance, you might find a company that makes the latest it gadget or luxury item in your growth fund mix. Aggressive growth. Think of this category as the wild child of your portfolio. When these funds are up, they're up, and when they're down, they're down. Aggressive growth funds usually invest in small companies with lots of potential. International funds are great because you spread your risk beyond the U.S. soil and invest in big non-U.S. companies you know and love like Toyota, Samsung, Nestle. You may see these referred to as foreign or overseas funds. Just don't get them confused with world or global funds, which group U.S. and foreign stocks together. And of course, all that is from his website. But the issue that I have with Dave's stock market investing advice is, well, for one, he says that you should choose actively managed mutual funds with low fees over ETFs or picking and choosing your individual stocks. So Ramsey recommends mutual funds over exchange traded funds and individual stocks because mutual funds are designed to be invested in over the long term. It's possible to outperform the market by selecting the right actively managed mutual funds. And ETFs comes with costs. While the fees are usually lower than mutual funds, ETFs don't offer the professional management that mutual funds do. And my criticism is that ETFs can also be invested in the long term. While you have the option to trade them like stocks, you really don't have to. You can just keep them in your portfolio for decades. And if you're really lucky, when you actually do pass on your assets, even for centuries. And there are a huge number of different ETFs, many of which you give them a chance to try and outperform the market. You don't have to invest in an ETF that just tracks the S&P 500. You can also choose a growth-specific ETF, a dividend ETF, which I myself invest personally, or even ETFs that track specific industries or sectors such as the healthcare industry and even cloud computing, for example, or cybersecurity like that. Number 2, fees. As with any business, running a mutual fund involves costs. That's just how businesses are run. Funds pass along these costs to investors by charging fees and expenses. Fees and expenses vary from fund to fund. A fund with high costs must perform way better than a low-cost fund to generate the same returns for the investor. Even small differences in fees can mean large differences in returns over time. For example, if you invested $10,000 in a fund with a 10% annual return and annual operating expenses is 1.5%. After 20 years, you would have $49,725. If you invested in a fund with the same performance and expenses of 0.5% after 20 years, you will wind up with $60,858, which is essentially a $11,133 difference. There are some varieties of fees that may be associated with mutual funds. Some funds come with transaction charges for buys and sells or commissions known as those loads I was talking about earlier. And there are funds that charge a redemption fee if you sell shares you only own for a short period of time. Investors also pay ongoing expenses to cover the cost of operating the fund. This includes investment advisory fees, paying the fund manager and research staff, as well as transaction costs associated with buying and selling those securities within that fund. When evaluating a fund, remember that fees play a factor and may potentially detract from a fund's performance over time. You must understand that Dave Ramsey is running a for-profit business, a business that actually have dominant market share in the for-profit financial literacy industry in the United States of America. One of his lines of revenue is the Smart Investor Pro and endorsed local providers network, who pay him to be part of his, his endorsed local providers or his ELP. And those financial advisors need to make a living, so they're going to charge high fees for their services. Those fees come at high loads and expense ratios, and those mutual fund companies are also running their respective businesses. So Dave Ramsey, your Smart Investor Pro, and a Pro mutual fund businesses are making a profit. And what's the revenue source? Your investments. Often with hidden and confusing fees. You pay thousands of fees over your investing career or investing journey, and Dave Ramsey, the Smart Investor Pro, and their respective Smart Investor Pro companies makes money. Dave Ramsey is very adamant of saying that you can actually earn a 12% annual average return on a mutual fund. So he promises he promises that it's possible to earn a 12% annual return on your investments. But if you listen to this advice, you're very likely to have a major shortfall when it comes time to retire. Ramsey's 12% reality is actually based on simply averaging the return of the S&P 500, which he reports are 11.64%, but he rounded up from 1928 to 2020. The problem is simple average returns aren't the most accurate way to measure your investments to perform. If you invested $5,000 and your investment went up 20% in the first year and down 20% the next year, your simple average return is 0% since your investment went up and down by the same percentage. But you don't actually end up with $5,000 at the end of year 2. Your 20% gain after year 1 left you with $6,000. But when you lose 20% off $6,000 or $1,200, you end up with $4,800 at the end of year 2. Your actual ROI is negative 4%, not 0%. So, using the simple average returns really isn't going to paint a very realistic picture of how your investment is likely to perform. Instead, you need to use the compound annual growth rate, or the CAGR, which shows a more realistic 10.04% average S&P 500 return from 1928 to 2020. Burton Gordon Malkiel, he is an American economist and writer, most noted for his classic finance book, which is this book, A Random Walk Down Wall Street. It was first published in 1973, but this book is in its 12th edition as of 2019. He's the leading proponent of the efficient market hypothesis, which contends that prices of publicly traded assets reflect all publicity available information. Although he has pointed out there are some markets of evidently inefficient exhibiting signs of a non-random walk. So essentially, this book talks about the subject of how stock markets, which popularize the random walk hypothesis. Malkiel argues that asset prices typically exhibit signs of a random walk, that one cannot consistently outperform market averages. This book is frequently cited by those in favor of the efficient market hypothesis. Malkiel examines some popular investment techniques, including technical analysis and fundamental analysis, in light of academic research studies of these methods. Through detailed analysis, he noted the significant flaws in both techniques, concluding that for most investors, following these methods will produce inferior returns as compared to passive strategies. Also, Dave's balance of risk and reward isn't for everyone. In general, investors are willing to accept more risk for a greater reward or greatly reduce risk for a slightly smaller reward. Dave's investment philosophy doesn't do a great job of balancing risk and reward. He suggests dividing mutual fund investments equally into 4 types of funds: growth, growth and income, aggressive growth, and international. Growth and income is synonymous with domestic large cap, growth, domestic middle cap, domestic mid cap. Aggressive growth would be domestic small caps, and international is international. So with this, you kind of have a one-size-fits-all approach to investing. As you get older and close to retirement, your portfolio will likely change to reflect your reduced capacity of risk. And Dave, he's not really a big fan of bonds. And of course, the more older you get, you probably might want to consider adding some bonds into your investment portfolio. Yes, I do acknowledge that Dave Ramsey has done so much in the personal finance space and has taught the basic financial concepts and the importance of discipline to millions of Americans. There's really no doubt that he's helped make a significant number of lives meaningfully better, and it's impossible to count the number of people impacted by his show, his books, classes, and whatnot. Now, if you followed Dave Ramsey's investment strategy by investing in actively managed mutual funds with those loads and holding it for the long term, you still get to experience the magic of compounding interest. With a few key changes: investing in low-cost index funds, greatly optimizing your portfolio balance, risk, and reward, and opting for investment allocation based on your personal goals and needs will make your money work harder and more efficiently to build your legacy. Okay, moving on from index funds and mutual funds to now hedge funds. Hedge funds is a pooled investment fund that trades in relatively liquid assets and is able to make extensive use of more complex trading, portfolio construction, and risk management techniques in an attempt to improve performance such as short selling, leveraging, and derivatives. Financial regulators generally restrict hedge funds marketing to institutional investors, high net worth individuals, and others who are considerably sufficiently sophisticated. Although hedge funds are not subject to many restrictions applicable to regulated funds, regulations were passed in the U.S. and Europe following the financial crisis of 2007-2008 with the intention of increasing government oversight of hedge funds and to eliminate certain regulatory gaps. So famous hedge fund companies and managers that I know of. From one, I know of Bridgewater Associates, which is the American investment management firm founded by Raymond Thomas or Ray Dalio in 1975. In 2013, it was listed to be the world's largest hedge fund. Dalio is the author of the 2017 book Principles, Life, Work, and which is about corporate management and investment philosophy. It was featured on the New York Times bestseller list where it was called A Gospel of Radical Transparency. Dalio is regarded as one of the greatest innovators in finance, having popularized many commonly used practices such as risk parity, currency overlay, portable alpha, global inflation index bond management. You also have Gotham Asset Management, which was started in 1985 by Joel Greensblatt, who started a hedge fund, which was Gotham Capital, with only $7 million. At Gotham Capital between 1985 and 1994, Greenblatt presided over an annualized return of 50% after all expenses, but before general partners' incentive application fees, or 30% net of all fees. Greenblatt actually wrote the book, The Little Book That Beats the Market, in 2005, and then he re-updated it called The Little Book That Still Beats the Market in 2010, introduced the investment strategy of the magic formula investing, a method for determining which stocks to buy, cheap and good companies with a high earnings year and a high return on invested capital. You also have Pershing Square Capital Management, which is an American hedge fund management company founded and run by William Albert or Bill Ackman. His investment approach makes him an activist investor. An activist investor is a shareholder that uses equity stake in a corporation in order to put pressure on its management, like the C-suite. A fairly small stake, usually less than 10% of the outstanding shares, may be enough to launch a successful campaign. In comparison, a full takeover bid is a much more costly and difficult undertaking. The goals of activist investors range from financial increase of shareholder value through changes in corporate policy, financing structure, cost cutting, and etc. to non-financial divestments from particular countries, adoption of environmentally friendly policies. You might know him or probably heard of him in December 2012, where Ackman issued a research report that was critical of Herbalife's multi-level marketing business, which he called it a pyramid scheme. Ackman disclosed that his hedge fund, Pershing Square Capital Management, short sold the company's shares directly, not with derivatives, starting in May 2012, causing Herbalife's stock price to drop. Ackman said that the company would eventually crumble under regulatory scrutiny for operating what he calls a pyramid scheme, a claim that Herbalife denies. Herbalife has been buying back its shares, and the stock price has soared 50% that year, piling pressure on Ackman's $10 billion hedge fund as paper losses mounted and the cost to borrow the shares rose. Short positions in which borrowed shares are sold in hopes that they can be replaced at a lower price have the potential for heavy losses that increases as the stock price rises. Put options give the holder the option to sell a stock at a set price. Herbalife's stock price has risen in part by its decision to buy back a big chunk of its shares. A move many in the market interpreted as Herbalife trying to put pressure on Ackman into giving up his multi-year crusade against the company. And then Bill Ackman, he abandoned his shorting since a few years after that. Okay, and we're almost done. Robo-advisors. Robo-advisors are a class financial advisor that provides financial advice and investment management online with moderate to minimal human intervention. They provide digital financial advice based on the mathematical rules or set algorithms. These algorithms are designed by financial advisors, investment managers, and data scientists coded into the software by programmers. These algorithms are executed by software and does not require a human advisor to impart financial advice to a customer. The software utilizes algorithms to automatically allocate, manage, and optimize clients' assets for either short-run or long-run investments. Robo-advisors are categorized based on the extent of personalization, discretion, involvement, and human interaction. Robo-advisors collect financial situation information from the client to determine their risk tolerance. Then robo-advisors allocate a client's assets on the base of risk preferences and desired target return. While robo-advisors have the capability of allocating client assets in many investment products such as stocks, bonds, futures, commodities, real estate, the advisors are often directed towards exchange-traded funds. Most of my stock market investments are in a robo-advisor of some sort. So the technology itself is not really nothing new. Human wealth managers have been using automated portfolio allocation software since the early 2000s. The .com bubble crash technology consumer technology was like really building up because .com bubble, I think. But not until 2008 they were the only ones who could buy the technology. So clients had to employ a financial advisor to benefit from the innovation. The first robo-advisor that were launched in 2008 during the financial crisis. I think in 2010 you had John Stein, who was a 30-year-old entrepreneur who founded Betterment, and then he launched a company. And then, of course, over time from 2010, assets under management and robo-advisors actually went up. So the company's main service is automated goal-based investing, which manages portfolio passive index tracking, equity, and fixed income exchange traded funds. And of course, it also offers a taxable and tax advantage accounts for like retirement, and more recently it added human financial advisors and checking the savings account and other additional services, because essentially it's a fintech company. You also have Wealthfront. Again, it's an automated investment service firm, rivals Betterment. And of course, the chief investment officer is Burton Gordon-Macchio, who again authored this book, Run and Walk Down Wall Street, that came out in 1973, but over time it had been updated with newer editions. Because the newer one is 2019, so 1973 it came out, 2019. I'm sure that there were multiple revisions and updates. Example of robo-advisors are the smaller companies: Betterment, Wealthfront, Wealthsimple, Sigville Wealth Management, SoFi Automated Investing. Discount brokerages, you have Vanguard Digital Advisor, Fidelity Go, Schwab Intelligent Portfolios. Even banks and those larger financial institutions also have them. Goldman Sachs have Market Invest, Prudential Financials have Link, Wells Fargo have Intuitive Advisors, Ally Invest have Robo Portfolios, Bank of America have Mirror Edge Guided Investing, JP Morgan Chase have the Automated Investor, Morgan Stanley have Access Investing, Citibank have Citi Wealth Builder, Capital One have Capital One Investing, and US Bancorp have Automated Investor. And also you have M1 Finance. It's a part robo-advisor, part broker, and lets you have the total freedom to invest in what you want. You'll be able to build your own custom portfolio and then set it up on autopilot and let M1 do the rest. Unlike a typical robo-advisor, M1 requires you to know what you want to invest in, which may be great for more experienced investors, but maybe a little drag on newer ones. Currently, at the time of this recording, I use M1 Finance more specifically for a dividend portfolio that I'm trying to build in order to generate a dividend income source. I personally like robo-advisors because they provide automated, algorithm-driven financial planning services with little to no human supervision. A typical robo-advisor just collects information from the customers about their financial situation and future goals through an online survey, and then uses the data to offer advice and automatically invest the customer's assets. Most of your robo-advisors uses passive indexing strategies that are optimized using some variant of the modern portfolio theory, or MPT, which is a method that can be used by risk-averse investors to construct diversified portfolios that maximize their returns without unacceptable levels of risk. The modern portfolio theory can be useful for an investor trying to construct efficient and diversified portfolio by using ETFs. And these robo-advisors, they make money by charging assets under management, while traditional human financial advisors typically charge 1%. Robo-advisors, at least for Betterment, they actually charge 0.25% per year. Not to mention, they also offer advice, automated advice, and they don't really actively trade stocks heavily, unlike an actively managed mutual fund does. So what are the shortcomings? Well, the entry of robo-advisors have broken down to some traditional barriers between financial services and the average customers like myself. Because back in the day, in order to have a financial advisor, you probably need like $250,000, and then they'll probably charge you a whole lot of money in order to manage that money. But for someone like me, or maybe you, who have less than $250,000, or maybe you just want to just get started investing, because of robo-advisors, it's a good way for us to start investing, especially for the younger millennials and the Generation Z. Still, many in the industry still have doubts about the viability of robo-advisors as a one-size-fits-all solution when it comes to wealth management. They're just a good entry level for people with small accounts and limited investment experience, like myself. When I actually had limited investing experience in 2019, so I did invest in a robo-advisor in 2020. Like actually be serious about it while still learning how to. When I was still reading more about random walk down Wall Street, see like how does the stock market really work. Of course, I do have like multiple books like this one and all others because I have a whole lot of books. I'm trying to diversify my assets, so I have real estate books, like books. I'm just because I'm kind of like a slow reader in general, but I'm eventually bought the book, heard about it, heard good things about it, but I'm actually going to read it when the time comes. Okay, and that's the video for actively managed mutual funds. Now, here are my thoughts about mutual funds in general. So most of my stock investments, besides my thrift savings plan, which is the U.S. government employee version of a 401k, is actually in robo-advisors. As a risk record, I use Fidelity's Go for my general wealth building for exponential growth for my family's stock portfolio. I used Betterment platform for goal-based investing. Primarily, I use that for down payments, which is a sum of money that a buyer pay in the early stages of purchasing an expensive good or service. Essentially, I treat that as a supercharged savings account. The down payment represents the proportion of the total purchase price, and I will usually take out a loan in order to finance the rest. So I would use that platform if I'm trying to save up for a down payment for my new house, a new rental property, down payment for starting a business from scratch, a down payment for buying a business. Like if somebody sells like a pizzeria, and then I have the money, so like, okay, here's the money for the pizzeria, and then I'll just finance it with a business loan. So I use that for like a down payment, or maybe a down payment for buying a franchise. Like, okay, here's the money, and then I'm just going to finance it like some other way. Of course, that's probably not the way how you would finance a franchise, but I'm still learning because, I also do plan on owning a franchise someday. But to get my point across, I'm trying to use this Betterment platform for goal-based investing, and those goal-based investing is mostly going to be down payment for an asset. And of course, other things would probably be like a lifestyle purchase, like maybe a brand new car. Like okay, instead of me just using cash for savings, let me just put into this robo-advisor, which is probably going to be more heavily tilted towards bonds and a little bit towards stocks. So I'm just going to keep adding, and then when it's time, that's the down payment, and then I'll just finance the rest. And I also use MO Finance for my dividend portfolio for dividend income. Okay, this is Dawson Discussions. My name is Nathan L. Dawson Jr., and I will see you in the next video. Take care and have a nice day.